What are banks? So when you think of banks, what do you think about? You think about, well, loans and deposits, right? So that's what commercial banks do mostly. So what they do is they serve retail and wholesale individuals. What does that mean? Retail is you and me and small businesses. We go give our money, tell them we want to deposit it, and they give us an interest, and then they give out money as loan and they gain an interest, right? And similarly, for bigger corporate and institutional clients, they do the same thing, but those banks are then called a wholesale bank, right? Now, secondly, investment banks have three general functions. One is mergers and acquisitions, M&A, IPO, or generally any kind of equity distribution or debt distribution. And finally, restructuring of businesses. M&A is when you have two companies, they want to get merged, X plus Y becomes XY, right? That's a merger. Well, if instead X wants to buy Y entirely and make Y a part of X, then that's an acquisition, right? So where do investment banks come in here? They advise them on what companies they should acquire, what companies they should merge with. They look at like fundamental analysis of a company, what makes a company grow, or if it's a good investment to make, and so on. And in terms of IPOs or the IPO stands for initial public offering, or any kind of debt or equity issuance, right? They need to value what a company is worth. And who does that? IB does that, right? And they tell you what a share price would be for a company and all these details and any advising that they do when it comes to an IPO. And finally, restructuring generally happens to companies that are not making a lot of money, right? And then you bring an IB to kind of look at your business and say, okay, these are the places that are losing money. This is where you are potentially going to gain money, so let's like restructure your business such that you make more profits, right? So these are the functions of both commercial and investment banks. Next, we talk about the risks faced by the banks, right? So there are largely three different kinds of risks here: credit risk, market risk, and operational risk, right? So first, let me talk to you about credit risk. So credit risk in general is the risk that your borrower is not going to return the money they owe you, right? Or in case of derivatives, derivative contracts, they don't honor the contract in when they are not negative position. So let's break it down further. Let's talk about loans, right? So when I give you a loan, I assume that you're a person who has both the capacity and has the honor to return the money back to the bank with an interest, right? But let's say you keep not paying your interest, or let's say you pay your interest for a little bit and then you suddenly go, okay, decide, no, but I can't do this anymore, right? And like the bank gets a big loss, right? So this risk that you will not pay me back the money you took from me, or the interest, or both, right? That's a risk that the bank is taking. And in case of derivatives, let me give you an example so that we don't have to get into the concept of derivatives as of yet. So let's take this example where 5 days from now, you and I have a contract where 5 days from now, I get to buy stock X from you, right? At a price of 10 rupees, let's say. And so, what you should be doing is, as an ideal person who wants to honor this contract, you have this stock that you have bought and kept, and you will keep holding it, right? And on the 5th, if I choose to exercise my option of buying it from you, right, I can buy it from you at 10 rupees per share, right? And so today I will pay you some amount of money and say in 5 days from now, if I want, I will buy this share X at 5 rupees from you. But what happens is sometimes, let's say in the 5 days, the shares price has gone up by like a lot, right? Let's say now it's worth 20 rupees. Now, you, as the person who owns the stock, has a couple of options, right? You don't have to honor the contract that you signed with me, because you know that you can sell it on the market and make much more money than giving it to me, right? You are in a negative position if you honored my contract, but if you went and sold it in the market, then you're at an amazing profit. So, because of that, you might not end up honoring my contract, right? So that is also a risk that the bank takes when they have these contracts and these products. Secondly, market risk. Market risk is just the idea that whatever assets the bank owns, right? The value of it keeps changing. Why? Because bank owns stock, right? This stock is going to go up and down on the stock market. So on those cases, you're going to have to like remember that your stock market is volatile, which means the assets you hold may not exactly have the same value every day, all the time, right? Finally, operational risk is the easiest to understand. It's basically anything that has to do with operations, right? Either it can be internal, where like a like a employee kind of like creates issues, or there's human error in the way you process your loans, or so on. Or it can be something external, like like having a cyber attack, or you can have like a person damaging your physical equipment, right? All that comes into operational risk. Next, let's talk about the different kind of capitals that your bank is required to raise and to hold, right? First, why do we need these capital? We need it because we need money for in the cases of your bank failing, or in the case that you have a lot of sequential losses, right? And you want to cover those losses for a short period of time, and then eventually you'll come back on a profit. But until then, you just need to have money lying around, right? So that's why we generally need capital to mitigate the risk of a bank failing, or making a lot of loss on like loans or assets or trading units, etc. So first, we'll talk about the two kinds of capitals that your bank will raise. Your bank will raise a debt capital and an equity capital. Your debt capital is your bank will issue a long-term debt instrument, right, which it will pay off eventually in a long-term horizon. But you have to remember that even if this debt exists, when a bank is facing financial stress, it has to prioritize money that the depositors of the bank have given the bank. So if your bank collapses, it will first pay out all the deposits, and then it will pay out the debt that it has to pay to these external parties from who they borrowed from, right? Next is your equity capital. This is a capital that that your bank gets by listing itself on the stock market. So your stock price, right, that you buy for that company, for that bank, it goes directly to the bank. Now, debt capital is known as a gone concern capital, because this debt capital is like it's absolutely repayable only when your bank collapses, right? Like your bank stops working, then the people who give the bank debt, they have to be given an answer to. And then and the equity capital is known as a going concern capital, because this is like if the bank has like given out a statement saying, oh, this quarter we're not doing very well, then your share price is going to decline, right? So this holds the tiny fluctuations in the value of your bank, right? And it makes sure that the company remains solvent. That means that if the company closes down, then your shareholders will get some amount of return from that capital still. Now, let's talk about the capital that they need to hold for sure, right? So, they need to hold a regulatory capital, which is the minimum amount required for a bank to operate, and it's determined by your bank regulators. So, your bank regulator will not let a bank operate if it's not able to satisfy this regulatory capital. Economic capital, on the other hand, is the amount of capital that a bank believes that it is required to hold based on its own internal models, internal like risk models, projection models, whatever kind of models they use. They make sure that we need at least this much after looking at those models, right? Both of these regulatory and economic capitals are supposed to cover any unexpected losses that come the way, and that way we mitigate any risk of any risk that comes from your bank failing. Now let's talk about the Basel Committee regulations. So Basel Committee regulations started initially to help and to like account for credit risk, right? That we talked about, where loan defaults are happening or people are not honoring their derivative contracts. So then over time, it started accounting for market risk and operational risk as well. And initially, banks were allowed to use their internal models for credit and market risks. But however, after the 2008 financial crisis, Basel became stricter and started using a combination. So if you're a bank that is approved by your national regulator, then you're allowed to have an internal model for credit and market risk. Now, even so, you have to have a comparison in your internal and your external model before we determine what exactly is your capital that is required. Now, your external models are standardized models by Basel Committee. It has a standard approach as to how your capital value is calculated. So, this standardized model value and the value from your internal model are taken, and the internal model value is compared to the 72.5% of your standardized model, and whichever number is bigger, that becomes your current capital requirement, right? So that is how they calculate your capital requirement, and it is absolutely essential that your bank is able to have that much capital at hand. Now, during the 2008 financial crisis, one problem that magnified the crisis was that there was very little liquidity. So now there are two ratios to ensure that it's liquidity. One is the liquidity coverage ratio, which is basically to make sure that your bank can fund itself and remain viable for 30 days in the event of a minor financial crisis, right? Or a minor financial stress period. This is to ensure that at least for 30 days, your bank is able to run. And then hopefully in 30 days, it'll find ways to liquidate the rest of its assets, or it'll find ways to borrow, etc. Next is the net stable funding ratio. This is a ratio that attempts to control the difference in your maturity dates between your assets, between your bank's assets and liabilities. Here, let's try to understand what your bank's asset and liabilities are. Your bank's asset is something that it makes money on. So it makes money on loans, right? What is a liability? It's the thing that bank owes money to someone else. So the difference is that, let's say I take the money from depositor X's deposit and then give it to Y as a loan. So the tenure for the loan might be different, the tenure for this person's deposit might be different. So I need to make sure that if this person, depositor, comes back and says, I want my money, I'm able to give them their money, right? And because generally loans are longer term than deposits are, you have to make sure as a bank that you're able to pay back your depositors on time. If you look further into the financial crisis, the liquidity issue cost what exactly? It cost customers to not get their deposit back, right? So, one way of the government trying to protect the customers is by having this concept called deposit insurance. So, this is an insurance where your bank is paying premiums to an insurance company which insures your deposit. So, as a customer, you can go claim this insurance in case your bank fails and is not able to pay your deposit money back, right? So this bank X, you have deposited $5,000 with the bank, and the bank fails, but the bank had a deposit insurance with an insurance company. You go to the insurance company and say, listen, I had $5,000 deposited with your bank, you need to give me that money back, and they will give you the money back, right? There's obviously some maximum amount that it will give you and not more than that. But there now exists a way for general small time customers to get their money back in case of bank fails. Now, the problem with this is, now as a customer, I know I have deposit insurance, which means I now will feel more risky, right, to go give it to small banks or to give more risky banks my money and say, well, I know you give me a lot more return because you take a lot more risky uh, operations, right? You bet on riskier assets and you buy like riskier stocks to increase the interest on my money. So I'll give it to you. And if you fail, I anyway have deposit insurance, so I will take my money from them back. This is this idea, right, that people are less worried about their money and are willing to take more risk because they have an insurance. That's called a moral hazard. So one way this is a problem is because now people are being careless, which means your insurance company is going to take a lot more of the heavy lifting, right? Because you are being careless, now they have to pay you off more times or to more people. So to counteract that, we have something called the risk-weighted premiums, which is where a bank that uses more risky methods of investing pays higher premiums instead of a bank that is well financed and is in a good situation and has good liquidity and good net stable funding ratio. They will have to pay lesser premiums. Now let's dive into investment banks' financial arrangements. When an investment bank arranges a securities issuance or an equity issuance for a company, then it does so in two different ways. One is the private placement, where it goes to a small set of investors who are qualified, who understand the fundamentals of the company, and they want to purchase a stock, a share in the company. Then the IB firm gives them the chance to buy it, and then the IB firm makes a little bit of money because it arranged this endeavor, right? Or maybe it even gets a commission, right? Now, in terms of public offering, there are two ways that your IB firm can do it. One is by firm commitment, where the IB firm will negotiate with the company and buy all of those shares that the issuing company is issuing at a price, right? And then the IB firm will list it at a spread higher than the price. So, for example, the IB firm will buy the shares of the issuing company at 5 rupees and then it will go to the stock market and list it for 6 rupees. So, the difference is what they will gain. So, this is a pro. But what is a con is now on public offering, maybe not all the shares will be subscribed to. Maybe that there will be some unsold shares, right? Now these shares now become a part of your IB firm's portfolio, which might not be what the IB firm wanted in the first place. Now, another way to do it is best efforts, where your IB firm just acts as an intermediate, right? They get paid to arrange the IPO, right? By valuing, by giving them what share price they should be listed at, right? And they don't hold liability in case some of it goes unsold, right? And they just agree to help distribute, and they just get paid a commission or a fee for the same. Now, we should also talk about how IPO pricing works. So, what is Dutch auction that I've written here? Dutch auction is basically that, let's say the company starts saying, I want to sell the shares of this company at 10 rupees. And then there's a first buyer and he says, well, I think 10 rupees is too much. I can probably do with 8 rupees. And then you and the person negotiate, the company and the person negotiate, and then you come down to 9 rupees per share, and then the buyer says, okay, I will get 10 shares at 9 rupees each. And then you go to the next buyer and then you ask them, okay, this person bought it for 10 rupees, for 8 rupees, 10 shares. What are you okay with the same deal? And then maybe you negotiate with them and it goes further down. So you keep negotiating till you reach the last buyer. And then whatever price the last buyer buys the share for, that now becomes your IPO price. Now, why is this not always dropping to like zero? Because there's a demand and supply ratio, right? So if it's a good stock, then people will want to buy it and will want to give more money for it. So that makes sure that wherever the supply and demand meets, that is your pricing, right? So hence your IPO will get priced fairly. Two things to remember importantly with Dutch auction is that one, this is just one way of figuring out what an IPO price should be. And secondly, that this process is done until the last buyer buys, which means that all the stocks, all the shares, right, are then emptied, right? The price of the last share that it is sold at That is the price of your IPO. Next, let's talk about conflicts of interest that can arise in banks. Now, when a bank has multiple divisions, it's very easy for one division to influence the other. For example, if the bank is doing a public offering for company X, but then it also has financial advisors advising their customers to buy the shares of company X, or it is telling an analyst uh, on their trading desk to say that you should buy this because it's a very good stock and it has great fundamentals, then your bank is playing an unfair game, right? It's increasing the value of your public offering by artificially giving it good reviews and good feedback. Or let's say that a bank comes to the bank, right? So your company comes to the bank and says, I want a loan because I'm not doing very well. And maybe this is not public knowledge yet, right? But it's knowledge to the bank now. Now the bank can go tell the trading desk and say, listen, this company is not doing well. They want a loan from us. So, maybe short it so that later we can make money of them failing. Or let's wait until there's going to be a headline saying they borrowed and now their value will fall, and then we can make a profit out of that. So all of these are not great practices. They're unethical, and obviously bank regulatories are like are going to feel very terrible about it, and they're going to want to not have this happen, to stop these processes, right? Which is why it is mandated that there are Chinese walls that exist, right? The Glass-Steagall Act by the US government does this, where they tell you that you need to have Chinese walls so that there is an internal control to prevent information from being shared among units that can influence each other. Now, moving on, we talk about what banking book and trading book is. So, banking book affects your credit risk capital, and your trading book affects your market risk. So let me quickly explain the difference. Banking book is a book with your assets and liabilities which are held to maturity. So these are always held to maturity. There's no trading them in the middle, right? So they would include loans which are like your primary assets, right? And they would be held until maturity for sure. Trading book will have assets and liabilities which are sold every time. They're available for trading generally, right? Which is why they are only marked on market risk. While your banking book is marked on credit risk because there is a chance of people defaulting, right? So it's important to remember that generally any asset goes into the banking book unless and until you have a trading desk assigned for that financial instrument, then it goes to your trading book. And finally, we are going to talk about originate to distribute model of loans. The originate to distribute model is something that you might be familiar with if you understood the 2008 financial crisis. So, what happens is when a bank gives out loans, it might not always continue holding that loan. So what that means is, I'm the bank and I'm giving you a loan, and I tell you this is your principal, this is your interest, right? But I don't want to wait until you pay your interest and your principal back, because for me, first of all, it's credit risk, like we talked about, and secondly, it takes me time, right, for me to get all the money back. So what I do is I take your loan and I sell it to somebody, so it's another bank most likely, and say, well, you take this and you give me this cash instead. So now these people, what they do is they might further distribute it and pack it into securities, right? This is if you understand the credit scores that people get, right? They have like a rating, triple A, double A, and so on. So they pack it into these rated loans and then they sell it further. So this continuous flow, right, from originating of the loan to it being distributed maybe once or twice or even thrice, right? This is the originate to distribute model. So this model is great for liquidity because, like I said, the bank doesn't have to wait until you pay everything back to have the money that it can make, right? Obviously, it's not going to make as much money as if you waited until you paid off the principal and the interest, but it's still going to have some money now. So money now might be better for them than money in the future. That means they have better liquidity for at the moment, right? So this is a pro of this originate to distribute model. The con is exactly what happened in the financial crisis, right? There's just looser standards about how these loans are packaged, right? And there's just looser regulations with it. People are less worried about, is it being rated correct, right? There's just looser standards, lending standards. So that's a problem and can cause a crisis like it did in 2008. So this applies to all kinds of loans: student loans, credit loans, residential loans, and this is a way for the bank to remain liquid while also giving out loans.